Hello everyone, welcome to the class again. So if you remember the previous class, if you have followed, you would have understood that in the previous class I was talking about how you can find the beta of the stock. So beta basically talks about the sensitiveness of the stock with respect to the market. So guys, in this present class, we'll extend our discussion further, and here we're going to talk about something which is very important called war. War basically means value at risk. If I'm talking about war, war basically talks about value at risk. So value at risk, what value at risk basically do? It talks about the maximum loss what you can have on your portfolio at a given time interval at certain confidence interval. So basically, what war basically do? It follows a normal distribution representation. Under the normal distribution representation, it basically calculate the maximum loss what you can get on your portfolio. So the maximum loss what you can get on a portfolio, this we determine for certain time period. The time period can be 1 day, 5 day, 10 day. Normally exchanges for calculating the risk factor, they basically follow 99% confidence interval for 1 day time period. Okay, so 99% confidence interval basically means out of the 100 cases, what they will test in those 100 cases, in 99 cases, what would be your maximum loss? That is basically we called as a war. Okay, so in order to calculate the war, the different methods are there to use war. We can follow Monte Carlo simulation, we can follow historical simulation. Different methods are there. So here I'm going to talk about these methods here. So imagine if I write here the time period. So the data what we had taken only 1 year data. Basically, for working on simulation mechanism, you need to have thousands of trillions of data. Like if you have more data, much more better result you can get. Here I have limitation. Okay, so since I have taken 1 year data only, so I have limitation of the data. So I have actually 246 data only. So I'll just calculate my war on 246 data only. Okay, if you want, you can take 1 crore data also. That's up to you. More data you'll take, much more better outcome you might get. Okay, so here I'm just want to write the value from 1 to 246 because the total value what I'm taking is 246 returns. I had data for that. So I got the value from 1 to 246. Okay. I hope please do not get confused why I'm taking 246 because my return is basically for 246 data only. Okay, so here I wrote 246. Fine. So then what you can do here, I can write the beta of the stock, beta of the stock, how much I got. So whatever value you got, you just write it here because beta basically is the relationship between the market and the stock. So this is the beta of the stock. Okay. Then what you can do, you can write the price of the stock. What is the today closing price of the stock? So if I take the price of the stock, I'm working on the stock called Bajaj Finance, right? I'm working on a stock called Bajaj Finance. What was the closing price of that stock? That was trading at 6,825. So I can write here 6,825. Where is my data on which I'm Excel I'm working? I think this is the so 6,825. 6,825. Fine. So here I have written the time period from 1 to 246. Okay. Then what you will have to do, write down the return on the index. What is the return on the market? Return on the index. Okay. What is your return on the index? Let me just copy that. Okay. This was the return on the market. Just copy this data. Control C. Come here and then do all DSV. Okay. Just paste this value here. Fine. Now what I want simulated return on the market, not the market, simulated return on the stock. Simulated return on the stock. For simulated return on the stock, what you have to do, you have to multiply the beta, because beta talks about the market risk. So just fix this cell, multiply the beta of the stock with the return on the market. This will give you the simulated return on the stock. Clear, everyone? So basically what you have to do here, when you go here, so you have to take just the beta. Here you're taking beta, you're taking the price. Okay, then market return, you just copy from the earlier calculation what you had done. Okay, just copy the data from there. Then stock simulation return would be what? Simply multiply the beta of the stock with respect to the market return. Okay, once you have done that, okay, once you've done that, then what you have to do, find daily gain or loss, because ultimately we are calculating VAR. So VAR basically talks about the maximum loss what you can get. So in order to find that maximum loss, for that, I'll take the price of the stock. Okay, this price of the stock, I'm finding this much percentage of the price of the stock. Okay, these much percentage what I'm getting on different time period. So that gave me the gain or loss on different time period. Okay, once you got this gain or loss, okay, then you can find the VAR. This VAR, basically I'm using historical simulation, because why historical simulation? Because I've taken the return on the stock which was already being determined based on the historical data. For calculating the VAR, I'll use percentile calculation. What basically percentile do? This function is available for Excel 2007 and earlier version. It returns the kth percentile of the value in the range. So out of the values on the range, which are normally distributed, I'm looking for the on the left hand side, I'm looking for 95% of the data. If I'm working on 95% confidence level, I'm looking for 99% of the data. Okay, so that data what I'm looking for. So for that, the data what you're looking for, you're basically calculating on gain or losses. Okay, everyday gain or losses what you're getting on the return on the stock. Okay, with that return on the stock which you found by simulation, and how you found? By multiplying the beta of the stock with us with the return on the market. And this you're calculating till what? Till 99% of the data. So what percentage of data you're excluding? Because if I'm calculating on 99% confidence interval, so I just exclude the 1% of the data which is on right hand side. Okay, so that 1% of data would be my VAR. Okay, so if I just press enter, okay, if I just press enter here, 1 minute, percentile on this gain or losses. Okay, 1 minute. You're getting this value. The here the VAR of the stock is around 106, because maximum loss what you can get on this stock is 106 rupees. Okay, so the stock is trading around 7,000 something, 6,825 rupees. So the maximum loss what you can get on this stock is maximum loss of 106 rupees. You're getting me. So here I have worked on this stock called Tata Steel. So this stock is trading at 134 rupees only. So here I'm getting the VAR value as how much as 1.608 rupees, because the stock closing price you can understand is very less. So the values what you're getting is also very less. And these I have calculated on 95%. For 99%, I have to write 0.01. Okay, so then I was getting my 2.52. My VAR was 2.52 rupees. So the stock which is trading on 134.75 rupees, the maximum I can get a loss of 2.52 rupees on the stock. Okay, while for this case, the maximum loss what I can get is 106 rupees. Clear, everyone? So this is one way of calculating the VAR. The another way you can follow Monte Carlo simulation. So in order to work on Monte Carlo simulation, first, if you want, you can just prove that your data is represented in normal distribution form. For that, you just what you need to do, just the return on the Nifty what you got. Okay, the return on the Nifty what you can got. Okay, just take that data, the return on the Nifty, no, which you calculated. How you calculated? you know the formula. Either you use log E formula, or you use today minus yesterday by yesterday. You followed that formula. So by using that formula, the return on the stock, what you got, okay, just take that data, go to insert, and insert, go to pivot table. Okay, under pivot table, okay, which table or range, this selected range or table, you can just press OK. And then here in pivot table, if I want to just reassign this, I just went to display and just clicked on this classic pivot table layout. I just did this, and then this return what you got, I just drag it under the row column. This return, I just drag it under row column. You got all the return value. The same return, I just drag it under value. You got the same value in total. With I want count. Here you might get sum. So you just go to value field setting and click on count. Once you got the count of this value, okay, then what you want, then what you do, just click here. Okay, just do right click, go to group. Okay, under group, what you do, starting by that value, ending by that value, and change this by 0.005. It will come by default as 0.01. Change this grouping by 0.005 so that you get the table as a class interval and frequency. Once you get this value, if you just select this value, if you just copy, Control C, just select this value, okay, and go to insert and just click on the covenant chart. You can see this representation. You will get somewhat like a normal distribution curve. So that shows, yeah, your data is in form of normal distribution. So now you're good to work on Monte Carlo simulation. In order to work on Monte Carlo simulation, again, you have data uh, till 246. Just write from 1 to 246. Okay, just write from 1 to 246. And then what you do, just generate a random number by using rand function. So basically, if you're using in Excel, if you're using in Excel called a rand function, so what this function will do, it will generate a random number. It will generate a random number between 0 to 1. So basically, for a lot of Monte Carlo application in OR also, we use rand function. So it generate a random number between 0 to 1. So what I we did, when we work on probability also, we use rand function. So basically what I've done, I just wrote from 1 to 246. Okay, and then what I did, I just used this formula rand function. Okay, so but what I did with this formula, okay, I just use equal rand, open bracket, close bracket, and it generated a random number between 0 to 1. Once I did this, okay, once I did this, so I got the random number between 0 to 1. Okay, then what I will do, okay, then what I'll do, I need the average return on Nifty and a standard deviation of the Nifty. How will I get the average return on Nifty? How will I get the average return on Nifty? For that, just use the formula average, and you already have the return on the Nifty, right? Okay, just copy that, Control Shift right, Control Shift down arrow, close bracket, enter. You got the return on the Nifty. Then find the standard deviation on Nifty. Okay, you got the standard deviation on Nifty. For that, go here and then select your value of Nifty. Okay, so you got the return, average return on the Nifty, you got the standard deviation Nifty, beta already you calculated, price of the stock was already given to you. Okay, then once you got these random numbers from 0 to 1, then I'll find the index return. For that, I'll use norm inverse formula. Norm inverse, what it will do, norm inverse. Okay, so it will ask you a probability. For probability, use this value, and mean return, use this value for mean return. Okay, log this cell. For standard deviation, use this value, log this cell, function F4, close bracket, enter. For all these random probability values, it will give you the return on the market. Once it give you the return on the market, once it give you the return on the market, then you have to find the return on the stock, like the way what we did in historical simulation. The same way you have to do. Okay, yeah. So how will you find the return on the stock? For that, you multiply the beta of the stock to fix this cell into the return on the market. Okay. So once you got this, okay, then I'll find daily gain or loss. For that, what I'll do, I'll take the closing price of the stock, again fix this cell into the the daily return on the stock what you got. This is your daily gain or loss. Okay, once you got this, then you'll find the VAR. Okay, how will you find the VAR? For finding the VAR, again you use a percentile symbol. So again you can find at 95% confidence interval or 99% confidence interval. Clear, everyone? So this is the way you work on Monte Carlo simulation. Similarly, there's another form of simulation which is called bootstrap sampling. So this is basically works on random sampling with replacement. So what basically you do in bootstrap sampling is that already the beta of the stock you have determined, price of the stock you don't know the VAR of the stock. So how will you find the VAR? VAR formula, so right? Percentile. Okay, so what formula basically we use percentile. In that we have to use the array. In that array, you'll take the gain or loss of the stock. Okay, how will you find the gain and loss of the stock? For that, you have to multiply the price of the stock. Okay, you have to multiply the price of the stock with the simulated return on the stock. Here, how will you guide the simulated return on the stock? For that, you need beta. Beta is already known to you, and you need return on the market. So in historical simulation, return for the return on the market, we just took the return on the market which we got historically. In Monte Carlo simulation, we got that return by using norm inverse formula. In that norm inverse, we use random number, and that random number randomly calculated the return on the market by fixing the mean and the standard deviation of the market. Okay, now here what we're doing in bootstrap sampling, we are finding the return on the market. How I'm finding the return on the market? For that, what I did for these 246 values, what I did here, I just wrote some random numbers. Okay, I just wrote random numbers. Okay, I just wrote some random number. That random number, what I'm writing, that should be between 1 to 246. Why? Because I have maximum 246 data. So what this rand between function will do, it will randomly will generate the random number between these two range. Okay, so I got some random number. Okay, once I got this random number, now what I will do with this random number? So once I got this random number, once I got this random number, what I want the index return corresponding to this random number. Okay. So I want index return corresponding to this random number. So these are the return on the market. Okay. And these are some serial number, right? These are some serial numbers. Okay. So I hope you know about VLOOKUP and all. Okay. So what I did in bootstrap sampling here, I just followed VLOOKUP. Okay, we lookup value, which lookup value to this value. Okay, where you have to search this value here out of this data. Okay, lookup value. Okay, then column index number. This is your value table where you need to look up, fix this cell. Okay, fix this cell. Okay, then lookup table array you understood. Then what is your column index number? So your column index number here will be what? So here your column index number, if you just see your column index number, so this is 1, this is 2, this is 3, this is 4, 5, 6, 7, 8. So here you have to write 8. Here you have to write 8 and then range lookup false. You got the return on the market. You got the return on the market. Just double click here, you get the simulated return on the market corresponding to these value like 171. The value should be 0.009. So here I can go and see 171. If I search for the serial number 171, I hope you understand how VLOOKUP works. You can watch my videos on Excel. If you go to the playlist in Excel, you'll get a lot of videos on VLOOKUP. The 171, you can see the return. The same return you will find it. Okay. Yeah. So fine. So here, if you just noticed, okay, make sure that in VLOOKUP there's a possibility of getting any error. Those errors should not be there. Otherwise, it will affect our further calculation. Just cross verify that part. Okay, once you got this, you got the simulated return on the market. Once you get that, you will find the return on the stock. Just again the same thing. Take the beta of the stock, multiply with the return on the index. Okay, then you will find the daily gain or loss. For that, take the price of the stock, fix this cell, and multiply with the simulated return on the stock. Once you get this, okay, then take this gain and loss and use this in percentile formula, and you will get the VAR of the day. Clear, everyone? So here in this class, we discuss the calculation of VAR by following three mechanisms, either by Monte Carlo simulation, either by following bootstrap sampling, or either by following historical sampling. So whenever you find VAR, you will find VAR at different time interval. It can be 1 day time interval, or it can be 9 day, 5 day time interval at certain confidence value. Clear? So this is what basically VAR talks about. If you go to the market, how intraday you market basically calculate the VAR. So 1 minute for VAR calculation. So this is article on the VAR calculation, how exchange basically calculate the VAR. So NSE introduced intraday VAR margin. How NSE calculate, you can just see this. So this is the calculation pattern. You can read by yourself. So from June 19, intraday VAR will be generated based on the share price at 11 a.m., 12:30 p.m., 2 p.m., and 3:30 p.m. every day. So VAR file would be provided to the brokers at the end or in the beginning of each trading day. The VAR gives the probability of losses based on the statistical analysis of the historical price and the volatility of the share, and is used for calculating the margin requirement. So this VAR is applicable practically across the market now. Okay, so now I hope you're getting. So at four time period, either at 11 o'clock or 12:30 p.m. or 2 p.m. or 3:30 p.m. at the gap of 1.5 hour. At four times, the exchange have their own software called SPAN, Standard Portfolio Analysis of the Risk. That portfolio will take the historical data of the movement